everyone, and welcome to today's Explainer. We have a lot of ground to cover, so let's just jump right in. Look, right now we are staring down a massive, flashing red disconnect between real-world data and current crypto prices. If you've been watching the charts lately, you've probably felt it too, right? Things are just feeling a bit off. So today we're going to break down the exact geopolitical and macroeconomic data points that the markets are, for some reason, completely choosing to ignore. We're looking at the hard facts drawn straight from our source material to really understand the explosive cauldron bubbling right beneath the surface of these markets.
So, I gotta ask you directly, are you ready for a flash crash? Seriously, because when the market finally stops acting irrationally, gravity tends to take over, and it happens fast. Think back to that recent carry trade unwind where we saw a brutal flush all the way down to the 40K range. Are you actually prepared for the moment this current irrational exuberance just evaporates? Because honestly, based on the underlying data we're looking at today, preparing for a sudden drop is exactly what we need to be doing.
All right, moving into Section 1, the risk of a flash crash.
Right now, there is this totally pervasive feeling of bullishness out there in the crypto space. But we really need to understand that this bullishness, it's kind of a massive illusion. It's masking some severe underlying vulnerabilities in the global financial system. Sure, Bitcoin and the broader market seem incredibly eager to pump. The charts absolutely want to go up. But this desire to climb is happening in a total vacuum. It's literally ignoring a heavily bearish global context. The market is just acting with extreme irrationality right now, and as our source material explicitly warns us, ignoring an explosive global setup like this almost always ends in a massive, rapid flush out of positions.
Let's dig into what's driving that. Section 2, Current Geopolitical Tension.
We are tracking some incredibly intense geopolitical risks right now. We're talking about escalating fears of potential retaliation between the US and Iran. We're seeing major military logistics in play, specifically U.S. aircraft carrier movements, with one reportedly leaving the region after a 10-month deployment, just as another arrives to take its place. Then you have provocative political discourse, like remarks from Donald Trump regarding renaming the highly critical Strait of Hormuz, all while traffic there remains at pre-war lows. Plus, there are new allied plans actively being coordinated to open blockaded straits. Now, impartially speaking, regardless of your politics, these are absolutely massive geopolitical escalations. They create an incredibly volatile environment for global assets, and yet, the market is currently pricing in zero risk. It's wild.
And that brings us to a hyper-specific, genuinely urgent catalyst: deadline day. The U.S. 60-day War Powers Act period expires literally today. This means that for the U.S. to continue military operations without a formal declaration, they need Senate approval or a formal extension. A lack of resolution here, or maybe a sudden, unexpected escalation to justify further action, that could send an immediate, brutal shockwave straight through the financial markets. It is a looming deadline that traders are completely brushing off.
Okay, shifting gears to Section 3, Global Economy Under Pressure.
Check out this data point. We just hit the highest PCE inflation since August 2023. Now, while the numbers technically came in right around expectations, the trend is undeniable, right? Inflation is creeping back up. So the absolute crucial takeaway here is that this completely crushes the market's hopes for immediate rate cuts. Especially when you have hawkish figures like Kevin Warsh moving to the Fed board, the idea of a June rate cut is looking practically non-existent. Actually, if inflation keeps getting hit by rising fuel and producer prices, we might even start hearing whispers of rate hikes again. No way around it.
And then we get hit with this deeply concerning number, 49.2. That's the U.S. PMI. The expectation was 54.9. And remember, anything over 52 indicates economic expansion. So dropping all the way down to 49.2, that marks the first economic contraction since December of the referenced cycle. Make no mistake, the U.S. economy is officially showing signs of shrinking.
But hey, the international economies aren't painting a pretty picture either. Just look at the global strain. Japan has been actively intervening in the markets to try and save the yen. Listen, when major, foundational global economies are forced into emergency currency interventions, it is definitive proof that the global economy is really struggling. That rosy, up-only picture being painted by overly bullish traders, it just straight up does not align with reality.
And we are already seeing the cracks form over in traditional finance. Total Wall Street dissonance. Major tech giants, right, like Amazon and Meta, they've seen their stocks drop even after posting really positive earnings reports. Think about that. When companies deliver good news and the market still decides to sell off, it reveals a deep, underlying weakness and a total lack of liquidity ready to push prices higher. The smart money is literally just sitting on the sidelines, waiting for confirmation that simply isn't there yet.
Which brings us to the ultimate technical divergence of this whole explainer. Section 4, the paradox, oil versus Bitcoin.
Let's compare these market behaviors directly, side by side. On side A, you've got Bitcoin. It's a highly risky asset that is currently testing massive, heavy resistance around those 74.5K to 77K levels, acting completely, totally oblivious to the macroeconomic warnings we were just talking about. Then, on side B, you have oil. Now, amidst all this Middle Eastern geopolitical tension, which, historically speaking, almost always causes oil to skyrocket, oil has unexpectedly dropped from 110 and is desperately testing its support levels.
And this sets up an absolute paradox. As our source puts it perfectly, one of these will inevitably fail. You simply cannot have a risk-on asset like Bitcoin pushing through heavy resistance, while a core, fundamental global commodity like oil crashes through its support amidst geopolitical chaos. It doesn't work like that. Either Bitcoin will fail to break its resistance and come tumbling down, or oil will fail to hold its support. They absolutely cannot both continue on these divergent paths. Something's got to give.
So what do we do about it? Section 5, the best strategy right now. The very first piece of strategy here is to beware the final wick, what our source refers to as the augulata final. Because there's just so much unresolved tension in the air right now, it is highly, highly probable that we're going to see a sudden, severe market flush. We are talking about a nasty wick down to the 70K or even 69K range. Why? To completely clear out all those over-leveraged long positions and shake out the weak hands before any true, sustainable upward momentum can actually kick off.
And let this number sink in for a second. 1. Right now, there is about one major DeFi exploit happening every single day in the crypto ecosystem. One a day. We're seeing incidents involving protocols like Azabi and Terra, where shockingly enough, a single wallet often controls the whole shebang. It's adding massive, systemic risk to the overall market. Guys, this is absolutely not the time to be blindly trusting risky smart contracts.
So here is your trader's playbook for today. Number 1, protect your capital above all else. Number 2, step back from active, high-leverage trading. Just put the mouse down. And number 3, observe until the market actually becomes rational again. With the geopolitical powder keg we discussed, the terrible macro data, and that glaring, completely irrational paradox between oil and crypto, sometimes the absolute best, most profitable trade you can possibly make is to literally just stay on the sidelines, protect your spot bags, and just watch. I want to leave you with this final provocative question to chew on. When the irrationality finally ends, and trust me, it always does, which side will you be on? Will you be caught overexposed in a sudden flash crash, or will you be standing safely on the sidelines, your capital totally intact, ready to buy the dip when the market finally faces reality? Take some time to think about your exposure, adjust your strategies, and please, stay safe out there. Thanks so much for joining me for this explainer, and keep a very close eye on those charts.